Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss who loses money in trading.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. So today's video will be a little philosophical. I would like to discuss what is the nature of the trading edge and who is on the losing side of most of the trades in financial markets. On a very short time frame, the markets are a zero-sum game. So it means that for each side that is gaining some money in the markets, there must be side who is losing the money. When I started Quantpedia more than 10 years ago, I was really driven by pursuit of the knowledge. So I wanted to understand markets properly and I wanted to know what to do to not be on the losing side of the market. Because, when you invest for long term, it's usually easier because you can gain some money out of the yield that's offered on fixed income securities or from rental yield, or you can gain money from investing in stocks that reflect growth of the overall economy. Investing is a little more easier. The trading is a different beast. The trading is done on a short-term basis, and for everybody who wins, there must be somebody who loses. So I did not want to be on that losing side, so I started to create a database of ideas, database of trading strategies to understand market really well, and not to be on the losing side of the trade. So the question is, who is on the losing side of the trade? What is the key factor behind the variation in trading strategy returns? What is the key factor in the variation of market returns at all? There are some research papers that are related to this question, and I would like to point you to 3 of them that are most interesting in our opinion, and they deal with this question. So we have a very nice sentence at the beginning of the block that I'm pointing you. So in a game of the poker, it is usually said that when you do not know who the patsy is, you are the patsy. It is good to know who are your counterparties, which investor trades drive the return of anomalies, and in this case you would know what they are looking for and you would better know how to take advantage of that. The authors, the Tamoni, Sokensky and Lee, they propose an approach to decompose the variation anomaly returns, so the returns of the trading strategies, into the effects of different investors trading and the motives behind their trades. I will not discuss exact methodology, it's the paper. What is interesting is what are the results. So the most important conclusion that I would like to point out in this video is that the small investors drive the most of the variation in anomaly returns. Small investors are those that are driven mostly by emotions, and they are the ones who are picked by professional investors who are not driven by emotions. They are very patiently implementing a lot of the different trading strategies, diversified all together. The direct trading of the small investors causes the flows and the ebbs of the markets and flows and the ebbs of the anomaly returns. So they are the main driver behind the anomaly returns. That is what shows the decomposition of the returns of the anomalies. And also, on the other hand, there are articles or there are the papers that are showing the same factor when you decompose the market returns. So not just the anomaly returns or trading strategy returns, but also the market returns. The similar finding is another paper written in the year 2022, so 1 year ago. The high capacity investors with a more precise price information have an impact on the price. Mainly the small idiosyncratic traders, so the small retail traders, they drive the price the way that those bigger companies and those professional investors can use advantage, and they can trade very well against those retail investors. There is another paper I'd like to point it out. Losing is optional, retail option trading and earnings announcement volatility. It's a paper about the option trading, and it shows that there is a significant trading around the firm's earnings announcements, and we can draw a connection between retail option demand and expected announcement volatility. The retail traders seem unwilling to close their option positions following high earnings announcements returns. This increases their losses. This is once again the paper. It shows that the emotional volatility of retail traders causes their losses, and on the other hand, the market makers are the counterparty and the active group that is getting earnings around those earnings announcements. They are offsetting retail investors' positions, and in the results they benefit from the behavior that's mentioned above. And it causes, of course, a large flow of money from retail to market makers. It doesn't mean that you should not trade the options. What are all those papers showing is that you must have very well built set of models with the quantitative rules that you must follow, and you must attend the trading from the business perspective. So it means treat it as a real business and not to be driven by emotions. That's what we are trying to do in Quantpedia. So we are trying to give you the collection of ideas for systematic trading strategies so you can build on. I hope that you like the few papers that I showed to you. Unfortunately, they are showing that the retail traders are not the best traders, but everybody can learn a lot. Everybody is learning, so even the professionals, and we can draw our knowledge from academic research, and I hope that we can help you with that. I hope that you liked the video. I hope that you liked the papers that I showed to you, and I hope that you join me in the next video, and I promise that the next one will be with the trading strategies or directly with the trading strategies. So thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.